What do you think? When are we going to get to 1%?
Well, it's an interesting question. Not long ago, I was being asked when we get to 2 or 2.5%. So it's interesting how rapidly sentiment swings. Look, I think 1%. It's a bit of a reach. I think, it's quite possible we see this downdraft in yields sort of extend a little bit. But to us, it's driven by a confluence of more sort of, cyclical factors. We're seeing positioning, of course, was extreme. We're seeing, data which cannot keep surprising on the upside forever, some sort of adjustment of that. But to move to 1% or lower, I think would really need some more of expectation of a fundamental shift, either a downdraft in the growth sort of outlook itself or inflation moving a whole lot lower. So that's why, look, as a baseline view, we think, there may very well be a period where all of this consolidation takes place. We move a little bit low from where we are. But, if this growth and inflation outlook remains, as a positive keel, we still think, on a 6 to 12-month horizon, we'll move higher, not lower. I think 1% or lower is a scenario where, the reflation trade itself starts coming up for question. That's not an environment where the Fed is tapering and raising policy rates. So it would take us, a few sort of key factors to change.
Is it also down to maybe bond markets looking at precisely what you just said, that you now have the Fed, we had the RBA yesterday, quite hawkish, you have the Bank of Korea, and several other markets have started to flag tightening of policy. Is that is this move bond markets telling us that pricing in that pull on growth moving forward because of this tightening cycle we're about to enter?
To some extent, yes. I mean, I think you're right that, markets do question that, look, if policy starts tightening and that gets priced in well ahead of the fact, how much can the economy take before it starts sort of hurting growth. But I think that's not it alone. I mean, if we do see tapering and eventually rate hikes, both history and the Fed's own statements would suggest that happens only in an environment where growth is sort of achieved more of a self-sustaining cycle, and inflation, of course, is, in the region of its target. So to me, I think what's happening in the bond market today may be sort of looking a little bit shorter term, saying, look, all that is great, and maybe growth is on a good path when you start looking out over a Fed's multi-year horizon. But between now and then, of course, we need to get off what's been massive fiscal stimulus, for example, on one side. We need to sort of adjust back from what have been very, very positive economic surprises. So I think there's a process of adjustment here. It doesn't mean the long-term reflation trade has gone away, but we've got a lot of euphoria, a lot of one-sided move over the past 12 months. And it's, looking back at past cycles, it's normal, whether it's the bond market or the equity market, that go back to a more sustainable, pace of gains, whether it's, in bond yields and credit spreads or in equities.
And there's still a lot of questions about this rally in commodities. Do you see a commodity price inflation as transitory, Manpreet?
I think it really varies on which commodity. I think we're seeing quite divergent trends. Gold, for example, as a precious metal, to us, that, we actually think prices can move, modestly higher. But to us, that's much more about what bonds and inflation do and that combination. And oil, of course, subject to its own sort of supply-demand issues. And there, I think, look, we were bullish if you go back over the past few months, but we're always looking for prices in sort of the $75 to $80 range. And we are now in that region. So, we could very well have some volatility around it given recent events, but we think some of the big sort of updraft or trend higher has occurred. I think specific industrial commodities, that's the one where, you could make a case that some of the multi-year trends in copper, for example, if you move towards ESG and demand for specific industrial metals continues, that's where you could argue the case is maybe a little bit stronger. But policy in China, for example, is leaning quite strongly against it. So a mixed bag, I'd say, a few sort of pockets of opportunity, but it does raise question about whether you take advantage of those through commodity markets directly or maybe through equities and corporate bonds in those industries themselves, where the risk reward might be a bit more attractive.
Okay, so tell us a little bit more about that. I guess it's a final question here. Within fixed income, DM yields are down. Investment grade in credit is quite low. You look at high yield, there's a little bit of a spread there. Where's the value right now?
So we see value most of all in dollar-denominated EM bonds, including in Asia. And some of that comes through, just looking at where valuations are relative to history. While developed market spreads are not far away from historical tights, we're seeing, valuations in EM dollar bonds now closer to the long-term median levels. And that, picture looks the same when you compare where, Asian and EM more broadly valuations are relative to developed markets as well. So I think that's sort of a good starting point. Within that, of course, in Asia, we've seen more policy pressure, sort of push spreads wider, but we think Asian high yield actually is looking quite interesting. If you take China real estate as a big component of that, for example, negative headlines, but actually recent policy has helped, starting to improve aggregate sector credit quality. That's one factor. And similarly, if you look at EM dollar government bonds as a whole, there's been worries about this rise. The previous rise in treasury yields was acting as a big headwind. That's now clearly, becoming less of a headwind, if anything, a short-term tailwind. So I think that's where we're seeing value. We've had sort of a run of bad news. There's been a tough first half for bond markets. And I think that's where, we'll be looking to exploit some of that value because bonds is about exploiting it, but also staying invested over a 6 to 12 month horizon to gather that yield.